Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Steve Wyett, Chief Investment Strategist at BOK Financial, as well as Steve Sosnick, Chief Strategist at Interactive Brokers. They join me to discuss fiscal policy impact on the market and government debt risk. Oh, and by the way, it is triple witch expiration in the options market. We'll touch on that too as well. Great to see both of you, as always. Steve's both from Nasdaq listed companies. Steve Wyett, I want to kick it off with you. Let's talk about this impact on the market via fiscal policy, because to your point, it really doesn't matter until it really matters.
Yeah, thank you, Jill. And by the way, just as a starting point, we want to approach this. This isn't a partisan type of a conversation. This is really this is a math issue. This is kind of what we're, as we think about this, it's not necessarily to support one stance or the other. And by the way, neither party owns the moral high ground on fiscal responsibility either. So it's just as we start with that, I think that as we've thought about the economy moving forward out of the pandemic, thinking about where we were last year with the Fed really raising interest rates and a general consensus that the economy was going to slow pretty considerably, what I think we missed was big fiscal. The fact that fiscal spending was continuing. And if we look at President Biden's budget that came out, which really, I mean, that's not going to pass in its current form, but it kind of, provides us with maybe a bit of a guidepost on what we may be thinking about fiscal policy going forward. It just appears that big fiscal is going to be with us for a while. And so I think that in the short run, we can look at that as additive to growth. That's probably going to, we're going to continue to see that fiscal spending support economic growth, probably help keep unemployment low. But I think all of us understand that we're on this path with 5 to 6% annual budget deficits in a period where unemployment's below 4% and economic growth is actually a little bit above trend. And you just go, man, how sustainable is that? And I think from a market perspective, the hard part is that you don't really know. We don't know when it's going to come, when that risk is going to really come to fruition. But in the meantime, it just is additive. It's additive to what our growth is. So it's kind of one of these ominous things that you look out there and go, man, this doesn't feel right. If you've got any type of fiscal responsibility in your outlook, it really doesn't seem like it's sustainable for a long period of time. But Jill, if you're asking for a number on, is it 38 trillion? Is it 50 trillion? Is it 150% of GDP? Who knows? I've been in the business since 1982, and we've been calling for a fiscal crisis pretty much since Reagan became president. So we're still waiting.
Yeah, and Steve Sosnick, your thoughts here, because of course we have to service this debt as well.
It's difficult to untangle the spaghetti somewhat, but the fact that bond yields had a pretty dramatic rise this week is a bit of a tell. It's hard to say how much of that was the inflation numbers and just the stock market and the bond market reacting a little differently. How much of it was the fiscal proposals, which would have caused different reactions in stocks and bonds. It's, again, I think this is not going to go through as planned. I think this was as much a political statement, of where Biden wants to be perceived going into the election, understanding that in essentially 50-50 House and a 50-50 Senate, it's going to have to, whatever comes out is going to have to be down the middle. But I think, in terms of that, there is something to worry about, whether that's, some people have thrown out 130% of, debt to GDP. We're sort of approaching that now. The fiscal movements have been a very underappreciated part of the stock market rally. And I do think they've really contributed a lot and have really been the reason why monetary policy has been able to be somewhat restrictive and still have a good economy and still have good markets. The problem is, at some point, again, as Steve said, since 1982, we've been worried about this, the deficit financing. It's one of those things. It'll happen when it happens, and it could be, it could be next week, it could be next century. But that's really one of those things that's just sort of lurking out there.
Jill, I will point out, we did have one brief little period where that wasn't what we were all talking about back in the late 90s when Bill Clinton was president. We actually had a balanced budget. And I remember at that time, there was actually discussion about what are we going to invest in when we pay off all of our treasuries? Well, we've effectively avoided that risk of investing. But I think Steve brings up another really interesting point on this from a fiscal standpoint. And this is how we've chosen to fund this debt. So much of it we're funding on the short end of the curve, where something like 55% of our bonds will mature over the next 3 years. So this impact to the budget as the Fed raised rates to fight inflation, you've just seen our interest expense as a percent of tax revenues just explode higher. And so that interest expense actually resides within the discretionary part of the congressional budget, but it's going up on a straight line. In fact, I've seen data that will exceed defense spending before the end of this year. So some of this stuff, I think it can be a bit nebulous, but there's going to be some things kind of start smacking us in the face here that I think are going to start to get some more attention.
Yeah.
If I just may say, add one more thing, that is really the problem with the way government accounting works is, you know, in a personal budget, you know, it's sort of okay to do deficit spending to buy a house, to invest in a business, to buy a car. These are all things, you know, this is the infrastructure part of the budget. Paying down debt, interest rate expenses is a mandatory it's a necessity, but it's unproductive. It's just money.
Right.
It's just money moving from one sector to another without creating anything. And that's, I think, where the tipping point comes at some point. And again, I hesitate to put a date on that because we've heard about it for decades, and it could be any time, if ever.
Right. So Steve Wyett, do investors, if you have your longer term investing hat on here, do they just stay the course? I mean, are there any recommendations in terms of how you shift your portfolio around? I mean, to both your points, we've been worrying about this since 1982, and investors have done quite well from 1982 until where we are right now.
Yeah, look, this isn't something that you can build into your plan, to your point, Jill. It doesn't alter materially what somebody's asset allocation should be. Look, there's plenty of stories out there that if you want to extrapolate this situation out to a really negative outcome, and the only way we can survive is to live in a bunker in South Dakota, filled with canned goods and ammunition, that's out there. That's not where we think that's going. But I would point to, as Steve mentioned, rates were up a little bit this week. It looks like the last mile on inflation is going to be a little harder on the Fed than maybe what the market had anticipated. But the other thing that's going on out there, and these are both kind of outside of our process, but gold setting all-time record highs during this period of time, Bitcoin and even more speculative asset class setting all-time highs. There are things moving out there that kind of make you sit back and go, it's not a clear picture. It's certainly not something that you can say, okay, then this is how the dominoes are going to start to fall. But there's enough movement out there that it's clear that there's a lot of uncertainty in the capital markets as we think about how this is going to unfold moving forward.
Right. And Steve Sosnick, speaking of other areas in the market moving, I mean, the notes that you've been putting out, it's NVIDIA's market, and, we're all living in it, but we're also starting to see some increased volatility with NVIDIA as well as the Nasdaq 100 overall. Do you think that the tides are changing a bit here?
I think it's a concern, Jill. One of the adages I was taught early on was volatility tends to increase around turning points. And when I say here about with NVIDIA, it's the historical volatility that's been rising. And it's pretty much the highest level it's been in a year or more. We did have some higher readings in 2022, but that was because volatility in the market was overall much higher. NVIDIA was a particularly bad actor because it was just as it's the poster child now for AI, it was the poster child for being the pick and shovel of the crypto business until that sort of collapsed on it. So we don't want to see those kind of volatilities again because that brings bad news. But it does make me wonder whether the NVIDIA trade is running out of a little steam, not necessarily reversing, but this as part of a topping process, you get increased volatility. It's not clear that we're there. And there are some very interesting dynamics that we see in NVIDIA and what I'm going to call the Fantastic Four, because it's no longer the Magnificent Seven, but where we're seeing, the FOMO from institutional managers being expressed as they don't want to miss the upside, but they don't necessarily want to be too heavily invested for fear of a downside. So they're using a lot of call options. And we see inverted skews in a lot of these names, meaning that the implied volatilities to the upside are higher than implied volatilities to the downside, which is historically unusual. And so I think you're seeing a lot of that type of activity in NVIDIA, where that's for the institutional managers who know it, who believe it's expensive and are very nervous. That's their way of holding their nose and participating in what I've been calling weaponized FOMO since since pretty much the end of November.
Mhm.
To kind of add on to that, Jill, too, and Steve, I'd be anxious to kind of get your thoughts on this as well. But if you look at fund flows within sectors, some of the more interesting periods for us are when you see fund flows like into tech, which have been very high, but the price action is not that great, and fund flows out of, say, energy, which have been pretty negative, but all of a sudden the price action in that sector is starting to look a little bit better. So you're starting to see this. It's a deterioration of maybe some of the price action at odds with where investors are putting their money. And so for us, that's another maybe marker that we're approaching some of this turning point, if you will, of kind of where the performance is going to be going forward, and maybe some things. And again, getting back to the inflation picture, if you just look at energy, if you look at materials, and these are smaller sectors of the economy or of the S&P, that makes it harder. But man, technically, those sectors are in a lot better shape than some of the bigger sectors. So again, there's this push and pull going on within the market. What has been working, what we think is going to work in the future, and maybe how you express some of those bets. To Steve's point, man, the way we express bets is so different now than it has been in the past.
One of the things that you pointed out brings me back to my, old Solomon Brothers training class days. And I remember the late great Laszlo Barini teaching us about money flow. And it was, his real innovation was, sort of, and he did it in what seems sort of a quaint way now, basically is the money on upticks greater than the money on downticks, that kind of thing, is money flowing in or out. And what you're talking about, Steve, is sort of the money flow argument, the rotation argument, where the money's coming when it seems that there's a lot of money coming into a sector like tech, but it stops going up, or conversely, energy money seems to be flowing out, but it doesn't go down. That's telling me that there's rotation. Right. that the willing buyers are being met by willing sellers where they hadn't been before, and vice versa. And that's where you want to be keeping an eye out for turning points, precisely.
Yeah. Steve Sosnick, stay with me for a moment here, because it is triple witching options expiration without sounding flippant here. I mean, it doesn't even feel like it's a blip on the radar today. You haven't even heard that much about it. Is it because there's a proliferation of so many new products on the market right now that it's changing, I don't want to say the structure of volatility, but different dynamics within the volatility space?
One thing to keep in mind is as we've evolved, what's really happened is the zero dated options aren't necessarily a new product. It's just really a compression of the expiration cycle. Unfortunately, when Steve and I started in the business, we were talking about monthly expirations and quarterly expirations were the big to do. That was witching hours, witching days. In 2005, we started to get weekly options. So then you started to compress the expiration cycle that much more for, call it, the top 600 names, which expired once a week. And then very quietly, we started to get Monday and Wednesday expirations, but it really wasn't until, and actually even in 2022 was when we actually got daily expirations, but no one noticed because it was a bear market. No one cared. That we really started to notice last year. Actually, that I timed the date to me was the first week of February 2023. We had a Fed meeting and a jobs number, a Fed meeting on Wednesday, jobs number on Friday, and people went crazy buying it because Powell used the word disinflation. This was over a year ago now. Used the word disinflation. Market went nuts Wednesday afternoon, went nuts again on Thursday. But people realized, oh, wait a minute, there are options that I can buy in things like spiders and cubes that I can trade this rally and not have to hold a position over the jobs number. But still, there's nothing fundamentally different about them. It just means the expiration cycle has been compressed. But today's a very interesting one, and that's part of the reason we're seeing a bit of a downtick, and that is because the S&P 500 is rebalancing today, and S&P, when it's not being forced by a corporate action, they tend to do their rebalancing around these triple witching days. You have SMCI and Deckers, DECK, going in, and you have Whirlpool and Zions Bank going out. Well, that's about 85 billion in market cap going in and about 11 billion in market cap going out. And one of those stocks, 60 billion worth, SMCI, has, oh, by the way, like quadrupled in the last 3 months, which is not exactly
We
normal
weren't even
price
talking
action.
about SMCI in Q4. Well, let's call it, beginning of Q4. No one even wasn't even on the radar.
It was good. But I pulled up some charts today, and you could see them on IBKR campus. I was originally going to do a year chart, but it was kind of dull because it was flatline until the start of the year. And then I said, all right, let me do 6 months. It was flatline until the start of the year. So I compressed it a bit because just because this late run is so outstanding. And so I think you're getting a lot of price action today as a result of that. Because if you're an index fund manager, you have to sell 500 stocks in order to reweight the two that are coming in. It also means, though, that you're going to get have the potential for some very interesting dynamics in SMCI. And you really have to watch out after the close, because if the stock sort of has this big run up into the close, and then exercise and assignments are being determined by OCC based off the closing price. But if there's some price action afterwards, you really want to be very careful about whether you want to potentially lapse some options, or if you're short options, be defensive about them. I wrote a piece about that today on IBKR campus, and I can't get it. It's too nuanced to do in this call. It would take an hour and a half, which doesn't make sense. So if you have SMCI options, please read through it. But I do think that gives us that's weighed on the price action today, and gives us something to focus on in an old-fashioned triple witching focus kind of way for the close.
All right. And Steve Wyett, final thoughts here.
Look, Jill, I think what Steve's talking about, honestly, if you just go back and think about how the market structure has changed a little bit, there just seems to be a much greater willingness on the part of investors to try and make bets that have these asymmetric kind of payoffs to the upside. And it's altered kind of how we think about liquidity in the market. It's altered how we think about the options market. I think this is where some of go back to the meme stocks and some of this stuff. This is where the idea of this long-term investor, a Warren Buffett kind of a build wealth over time, it's kind of fallen by the wayside to the idea of, hey, let's make a 10x on an option that will expire tomorrow, and that type of stuff is out there. I'm not saying that that's bad. It's different than what it was in the past, and it does provide maybe some differing looking opportunities going forward. But it's just reflective of a shift in how the markets are working today versus certainly 5 or 10 years ago.
All right, Steve, it's the dynamic duo. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Joe.